Alex, welcome. Thrilled to have you here today. Alex is the author of Out-Innovate, as you can see behind him. And Alex is also a venture capitalist. And Alex, before we even get started here talking about your book, I'd like to know about what you think the future for entrepreneurs and venture capital is, con considering what's happened with this pandemic.
Yeah, happily. And thank you so much for having me. I'm trying to up my virtual background game. So this is my first time trying this. So you'll let me know what you
It
think.
looks awesome.
Okay, very cool. Well, so obviously we live in extraordinary times at this exact moment. My view, if we take a zoom out for a second away from this exact moment that we're in now, I think the long-term trend continues to be really positive and exciting. I think on the one hand, it's easier than ever to start a business. Two, there's more and more interest in technology and startups. And three, we're seeing the proliferation of ecosystems and job creation through entrepreneurship around the world. And so the long-term trend of this, I think, will continue to be really positive. Obviously, right now, there is a moment where there's a lot of fear, rightfully so, around a global pandemic, looming fears of a recession, et cetera. And I think in this moment, there's also a lot of uncertainty around how behaviors will change in the long term, and how working from home might change the nature of work, and what, how the changes in travel behavior will affect hotels and things like that. So I think there's a lot of things where there's uncertainty, and we'll have to see a little bit where some of this shakes out. For us, I'm spending a lot of time thinking about our portfolio. Some of the companies I think will be well positioned, and it'll be an advantage, and others obviously are going to have to recalibrate, and it's going to be a tough moment. And so I think it's a mixed story, but I think one that's unfolding in real time.
Do you think that you'll continue to invest, or will you be putting money aside just for your portfolio companies?
Oh, so as a firm, we always have reserves for portfolio companies, but absolutely, we will continue to invest. My bet over the long term of this is that it's really exciting, and there's going to continue to be some fabulous opportunities. And in many downturns, some of the greatest and most iconic companies have been built. And so I think we'll learn a lot about many problems that exist, and we'll find some innovative solutions for them at the same time. So yeah, absolutely.
That's fantastic. Do you think, one more question on this, and then we're going to jump into your book. Are entrepreneurs, do they need to think about that they're going to have to reduce their valuations significantly because there's going to be less money out there, especially from angel investors?
I think we'll see. I think there'll be a moment of recalibration. Valuations are reflective of the potential of the business and the growth prospects of it, et cetera. And for some companies, things are going to continue going well, and I think for others, there'll be a moment of reflection and recalibration. And so I think there will be some adjustments. So I think it'll depend on the business and the market and where they're at. I believe that the best businesses will continue to get funded, and continue to get funded really well. But I think it's also, there's a moment where a lot of VCs are taking a moment of pause. And so, let's see how it shakes out. I think it'll depend on the industry and the business. That's probably a little bit of an unsatisfying answer for you, Mark.
Well, that's the best answer you can come up with right now.
Yeah. Ask me again in 2 weeks. I hopefully will have a better perspective, but we're seeing some, we're seeing the companies that are doing well continue to get funded and succeed and scale. And but I think obviously there's a moment where there's a lot of folks are having challenges too, rightfully, and people are buckling in. So
well, we'll have to have you back and get your perspective on it.
There we go. Okay.
So let's talk about your book. Why did you even write this book?
Yeah. So by day, I'm a venture capitalist, like you mentioned. I work for a global fund called Out-Innovate, which invests around the world, a third of it in Asia, a third in North America, a third in Europe. We also have a Pan-Africa venture fund in partnership with Africa Invest. And outside of work, I've been teaching entrepreneurship with the Middlebury Institute for International Studies, which is Middlebury College's graduate program in Monterey. And many of my students after school would go back home to, their hometowns, or, I grew up in the middle of Canada in the Midwest city called Winnipeg. A lot of folks were going back home or moving to emerging markets to build startups. And I was getting really frustrated that I kept assigning my students books on entrepreneurship that talked about one method of entrepreneurship that was very Silicon Valley centric, around growth at all costs, around how to build your team or what have you. And I always felt like I had to contextualize them to the reality of building startups in more emerging ecosystems. And Out-Innovate, my book, is a little bit of the product of that effort. Is I wrote the book that I wanted to share with them and with many of the entrepreneurs I was meeting who were thinking about how to build their businesses. And I think the best entrepreneurs operating in Detroit or Chicago or Amsterdam or Nairobi or Bangalore have more in common with the best entrepreneurs in Sao Paulo than they do with those in San Francisco. And no one was telling their stories. And so I interviewed about 200 entrepreneurs from around the world. And these are, the folks leading the biggest startups in all of these regions in the US, in Europe, and in many emerging markets that have built already, a couple $100 million businesses are already exited in the billions. And I think that taken together, some of the lessons that they have offer us an entirely different playbook on how to build innovation and succeed over the long term. And so that's what motivated me to write the book, and so I'll get out to put it to publication. It's coming out next Tuesday.
Well, has the world of venture capital changed in the past 10 to 20 years? Because it sounds like it has, and we've seen that it has, but it also, because you've noticed from your own teaching and the classes you probably took at Harvard, the changes that have occurred. So how has the world changed in the venture capital world and entrepreneurship in general?
Yeah, absolutely. So in many ways, venture capital is a tool that is in service of entrepreneurship. And so I think that entrepreneurship has changed in some meaningful ways, which is also reflecting some shifts in venture capital and vice versa, given the symbiotic relationship. But I think on the one hand, it's easier than ever to start a company. Silicon Valley was called Silicon because literally there was, building silicon chips. It used to be, to start a company, you needed to build, have servers, and it was meaningful investment. But now with things like the cloud and a lot of the horizontal software startups that are building distinct pieces of the infrastructure, it's easier and cheaper than ever for someone to start a company. And as a consequence, the value of being entirely located just in the valley with this network of capital, et cetera, was decreased. And so, so we're now seeing startups scale all over. And so that's the second dimension, is that there's now 480 startup ecosystems around the world, and some major ones popping up. And so innovation in this kind of tech-driven model, obviously entrepreneurship's been global forever, but this very particular startup-based entrepreneurship is really become global. And three, we're seeing it across a range of different products and services. It isn't just the traditional sectors, but we're seeing this proliferation of tech-enabled businesses where there's a mix of business model and tech-driven innovation. And so in the book, I talk a little bit about this notion that there is this emerging frontier of innovation. And in the book, it's principally a location, but I think there's actually a broader lens. But I think there are ecosystems like the Valley and perhaps Tel Aviv or Shenzhen or others that are really of their own. But there's a couple other dimensions where there are markets that are operating in more developing contexts, and that might be one axis you think of. And another might be the intensity or the developed, the nature of the startup ecosystem, how developed it is. And so there's places like Bangalore that are developing markets and yet have very developed startup ecosystems. And there are places like Detroit or Winnipeg, where I'm from, that have more nascent startup ecosystems, but operating in a more developed country context.
I have to say, I was surprised that Salt Lake City, we had Judy Robinette, who is well known for writing books for women about how to raise capital. And she said last year, I had her speak at the Angel Venture Fair conference. She said that there were 8 unicorn companies in Salt Lake City. 8. Yeah. And I never even thought of Salt Lake City as an entrepreneurial hotbed. And now, I'm 59, and when I got involved in the entrepreneurial world back in the 80s, it was just the United States. But now you have Israel, India, China, Sweden and all these other countries. What are other countries? Why are other countries seeing a rise in investable companies, and how are they different?
Yeah. So, because it is really important to think of global entrepreneurship as more nuanced than just saying, look, there's Silicon Valley and then there's everything else, right? There's actually quite, and so I was alluding a little bit to those dimensions where there's a bunch of this, but actually there's so much nuance even in the types of businesses getting built, how large the local market is, and thus whether or not, you know, businesses are getting built much more locally versus taking a born global approach and going across multiple markets. To answer your question, one of the reasons we're seeing it all over is this dimension that it's much easier than ever to start businesses. Two is this culture of entrepreneurship. I think has been actually a major export of Silicon Valley. Has been also this culture of entrepreneurship, what it looks like, and there's physical manifestations that you might see in the aesthetic and what, you know, WeWork has done, but there's also just kind of this ethos that we've seen. But yeah, to your point on Salt Lake City, one of the founders I interviewed was Ryan Smith, the founder of Qualtrics, which is probably one of the biggest wins in Salt Lake City. It sold to SAP for $8 billion. And what's really interesting is when you talk to founders like that, they talk a lot about the long-term approach. It took them over 15 years to sell to Qualtrics. It was a really long-term thing. The big breakthrough happened after 10 years. And so we're seeing the way entrepreneurship is done look different in different ecosystems. But some of the ecosystems I think are really exciting, besides the ones that you mentioned. You know, obviously in India, Bangalore, in Southeast Asia, Singapore and Jakarta ecosystems have been really scaling. In Africa, what's been happening out of Nairobi or out of Lagos is a different style of model. In Brazil, Sao Paulo. And what I suspect we'll see, Mark, is that different regions are going to be specialized in different ways. And so East Africa out of Nairobi is probably the best place in the world to do things on top of mobile banking. Things in China are really showing the rise around things that work within the super app ecosystem. India has actually inspired a lot of new models across the emerging markets, including in hotels or in evolutions of ride sharing and things like that. And so we're actually seeing this this specialization across different ecosystems as it's evolving.
So you write about companies should cross-pollinate in your book.
Yeah.
What do you mean by this, and how does someone do this successfully?
Yeah. This is, by the way, one of the most interesting aspects of entrepreneurship today versus before. If you look back 20 years ago, people thought of, oh, look, like Silicon Valley comes up with a model, let's say eBay, and then it gets copied in a bunch of other markets. What's happening today is actually, one, innovation ideas are taking root everywhere. And two, they're getting adapted over time in different markets. And so I'll give you one example. Ride sharing. Uber and Lyft, right, kind of pioneered the model in the Valley. That model was, you know, replicated across the world. But today, the largest ride sharing company in the world is in China. It's Didi, by multiples in size of where Uber's at. But what actually hides the story is that as that model was built in different places, it evolved. So Indonesia, Nadim started a company called Gojek, which today is a multi-billion-dollar company. And the way he thought about ride sharing was totally different. So he started, it was motorcycle taxis, not cars. But he thought about the whole day of the driver. So his vision was that in the morning, the drivers would drive people to work. At lunch, they would deliver food. After work, they'd bring them home. In the evening, there'd be, but also all of his drivers were mobile banking agents. So they could provide financial services and other things like that. And so he thought of this super ecosystem of services. And that model has actually come back and influenced Silicon Valley as well. It's no surprise now that Uber has Uber Eats and has an Uber credit card and all these other things. So we're seeing this bilateral shift of innovation where ideas are emanating not just from the Valley, but from India or from China or from Nairobi, but also the ideas are getting better. So that's one dimension to it. The second, at the same time, is as you're thinking about cross-pollination, localization and understanding the local context is really important. My favorite story on this is the story of matrimony.com, which is the leading online dating site in India. And when Murugavel, the founder, was actually moving back. He was a repatriate from the US. He moved back to India. He was building this thing, and a lot of his peers thought he was nuts for a lot of the things he was doing. So instead of just the traditional online matchmaking, he had a forum for parents to be part. He had a feature so that people could do background checks on the other person, because the mothers of the brides wanted to check that the guy had, you know, the university degree or whatever that they had, and all these things. He had set up physical places for families to meet. So he actually had these trusted network. And so totally different thing. And so, you know, while inspiration can come, it's equally important to localize. To your question on how to do this effectively, you know, I think one of the dimensions that we see is that founders that do this effectively have this broad lived experience. Often they've traveled, lived across different regions, worked across different industries, and are leveraging a bunch of these aspects to tap a global network of ideas, of capital, and keep that alive over time as they're evolving their business.
So what kind of skills does the entrepreneur of this century, and especially going forward, and now after we've had this pandemic hit us, what kind of skills does today's entrepreneur who's thinking in a global way have to operate, and what do they need to know and do?
Yeah, absolutely. I think one dimension maybe tied to this, to the point we were making before, is I think this cross-pollination ideas have become more critical than ever, and where business models will get inspired from elsewhere, but also it's a two-way street where they're going to learn from each other. So having an ability to build networks, not just locally, but across geographies will become critical. But I think to your point specifically around the context that we're living in with Corona, one of the themes in the book I explore is this idea of the camel. In the Valley, there's this modus operandi of how to build a startup, which is chasing unicorns. And unicorns isn't just a number, which is this idea of $1 billion company. It's also a philosophy on how to build startups. And that's the philosophy. The tool is growth, and the method is growth. It's growth at all costs. And that means it has meant, you know, subsidizing growth for user acquisition for growth, burning a lot of capital, those kind of dimensions. I think a camel is the more appropriate mascot. Not only is it a real animal that doesn't exist in fictitious lands, it's an animal that's built for survival, that builds sustainability and resiliency into the business model from day one. And what does that mean? So it means, one, having unit economics that work. One of the companies I interviewed is in Zambia. It's called Zona. It's a leading mobile banking company. And their motto is easy, quick, safe. It isn't free. It isn't cheap. You know, it's easy, quick, safe. And it's really about building a product that customers value and that are willing to pay for. And their solution is actually one of the most expensive in the markets. But despite that, because they're so reliable and trusted, people pay for it. The second is managing burn. And being able to do that as you scale. One of the companies I interviewed is Grubhub, which we think of on-demand delivery as kind of one of these venture subsidized models. But these guys built the whole business, raised less than $100 million, paltry by many of the Silicon Valley competitors like Delivery Hero. I think raised about $1.5 billion. Were profitable at every single fundraise. And they really thought about managing burn. And I think the third bit, we talked about Salt Lake City, is taking this long-term view. As you build. And so this camel skill set, I think, is one that's going to be really critical for entrepreneurs today and going forward to build strong, resilient, and long-lasting businesses.
Also, the camel holds its water for a long time, which means they're very good at managing and being efficient, right? So the companies have to be cash flow efficient when they're running their business.
Yeah, and so it's interesting. Mike had this great quote. He was reflecting. This is Mike Evans, the co-founder of Grubhub. He was reflecting. He's like, "Look, I could have gotten into IPO 2 years faster. It took him 8 years. He could have done it in 6 years, but would have done it at disproportionately more risk." And so, in some ways, it's about being efficient, but it's also about doing it in a way that that gives you a better risk-adjusted outcome for the business too.
So, what do you mean by establishing distributed team, and how does that enhance the competitive position of a company?
Yeah, so it's interesting. Distributed and remote have been terms that have gotten very much in vogue these last couple weeks, where my Twitter feed is exploding with people showing me their Zoom setups at home. But what's interesting is that entrepreneurs operating in more emerging ecosystems have been building distributed teams forever as a structure to build a business. And so a distributed team is where instead of having this traditional model of everyone goes to one office and that's where you work, is you're leveraging talent from wherever it's from. And there's obviously couple different manifestations of it. It can go from having a couple of different offices to all the way being fully remote and digital. And it's no surprise to me that some of the best companies that have done fully remote or even any of these distributed models have emerged outside the Valley. I think of Basecamp in Chicago, or Zapier out of Missouri, or Globant out of Argentina, that have really built this in. So distributed team, I think, has a couple different advantages. I think one is it lets you tap talent from wherever it is. I think talent is distributed evenly. Unfortunately, opportunity is not. And the amount of folks that's been there, done that, crew and startups, Silicon Valley has an advantage of that. But if you're able to build a distributed team and leverage it from wherever the talent comes from, you can get over some of those. So the second is you're able to manage labor costs. You can tap labor pools that are a little bit cheaper and less insanely priced than in some of the more major centers. And three is actually, it's a really powerful tool for culture, particularly if you're trying to build a multi-market business. If you're building a distributed team, you already have to fix many of these cultural pieces within your organization. And if things aren't working in a remote setting, it's really obvious much earlier. And so it sets you up to be an international firm really well. So I think there's a bunch of these different advantages. So that's what I think about with distributed teams. And obviously, in the context that we're in right now, everyone is now work from home. I think it's important to know that our context of work from home today isn't really the steady state, right? Like steady state work from home is not one where, I've got my baby upstairs right now who's crying, right? Thankfully my wife is taking the ship, but two, we've got macroeconomic fears, we've got health fears. Like that isn't the steady state of work from home. And when we build in best practice for that, I think this is an area where entrepreneurs that have been facing this constraint forever have already developed best practice, in some ways turn that constraint into an advantage.
So do you think now that every company and investors as well, because we have investors who are listening to this, should be now factoring in pandemics and global warming in terms of what they're going to invest in for the future?
I think...
or the types of companies that people are going to think about starting?
Yeah. I think that this event will be a really strong reminder of the importance of resiliency and sustainability. And if your business doesn't have, is burning a lot of capital and doesn't yet have a really solid business model, I think you're going to be in trouble right now. But I think it's a reminder for everyone that you will eventually be in trouble. Like if you keep raising a lot of venture capital but don't have a sustainable business, you're kind of kicking that can down the line. And so I think that this is going to be a big mental shift where this camel idea is going to become in vogue. And in some ways, it's a little bit of what's old is new type method. Like the idea of building resilient, sustainable businesses is not new. It's one where, we've had a shift away from that in a context of abundance and a really perfect environment in the Valley. But yeah, so I think we're going to see entrepreneurs and investors value companies that have these much more sustainable dynamics going forward. And this will be, in part because, who knows what the next challenge the world goes through. It might be a pandemic, it might be something else. But definitely, I think we know the world is uncertain. We've been reminded of that. And I think it'll be the camel that'll survive over time and will endure after all.
So we all have to buy camels.
You said it, not me, but I like it. Actually, I want to do a book launch event and have everyone do kind of some themed cocktails. And my idea is one of the cocktails will be the camel, which will be 1 part water.
Well, we'll help you with that. We'll get the word out for that. So let's open up for questions. One of the questions that I see here is Silicon Valley is a mindset. What do you mean by that?
Yeah, so it's a little bit of this nuanced point, but so Silicon Valley is obviously a place. It's a place that has unbelievable track record of building startups. But it's also been this philosophy and this approach to building startups at the same time. And what I mean is some of these dimensions, like you have to build a startup in a way that chases a unicorn, growth at all costs type of mentality. But it's also, how you build a team. It's local offices in office, people work, targeting the US market, et cetera. I think there's a bunch of these dimensions where there is a conventional wisdom on how to build a startup that is centered in the Silicon Valley model. And I juxtapose that with what I've been seeing, which is this alternate playbook that takes many of these deeply held beliefs on how to build a startup and are flipping them around. And so, one is this camel unicorn juxtaposition. I think another is this notion that startups don't need to be just US focused. Around the world, if you're operating a business in Singapore or in Nairobi or wherever, and you're operating often in smaller markets than the US, you're building a born global startup from the get-go. You're building something that can scale across multiple borders, that can serve a range of customers in different contexts. You're building a distributed teams. By the way, some of these things, I started writing the book 2 years ago, and the context changed a lot in the last 2 months. So it's really interesting now. We're seeing some of these ideas. Everyone's talking about building distributed teams now in the Valley. Everyone's talking about getting sustainability and resiliency. And so that I think is really powerful, is that with the context changing, we're seeing that these behaviors need to change to survive. And we're seeing that, folks that have been operating within that similar context outside of the Valley have some really interesting lessons. So anyways, I hope that answers the question around the Silicon Valley mindset.
Sure. The next question we have is, any camels raising money now we should look at as an angel investor?
In terms of specific names, do you mean? Or just kind of as an approach?
So I would say as an approach, or looking at a profile of type of company.
Yeah, yes. So I think that we're going to see a greater increase in companies built today, building within that context that they know and will be camels. So if I were an angel investor, and I do some angel investing, but I invest mostly kind of a little bit later stage at Series B. And I think the same thing is true for us. Yeah, absolutely. We're looking at camels, and it's important that camels is not a type of business. It's a philosophy on how you build it. And I think you could build a fintech business, a healthcare business, an edtech business in a camel-like philosophy. And so I think it's really about asking the questions around, how are you going to build unit economics? What do they look like? Really understanding the philosophy of burn, and how much runway they're going to have under different conditions and things like that. And so I think it's really pushing to understand and be able to answer those questions.
So one of our listeners asked, can you give any specific names of camels that they could look at, to understand their business model and so forth, and what makes them a camel? So are there any companies you would name?
Yeah. So I think it's tough to say, let's look at a seed stage company and say, are they a camel? I think it's easier to look at a company that's succeeded and been out. What do they look like retrospectively? And so the two that I alluded to earlier in the talk, which I think would be really good case studies for your listeners, one is the Grubhub story and what they did to get to their IPO, having raised less than $100 million in venture funding to get to a multi-billion-dollar IPO, being sustainable at every fundraise. And at the point that they fundraised, doing it for a very specific purpose. So one of the fundraisers was to expand to 2 cities. Another was to do a small acquisition. And so it's very thoughtful, mindful reasons. And the second one I mentioned was the Qualtrics story, which was actually self-funded for about a decade, and actually only did their first venture round was a secondary, and well beyond when they'd already gotten their breakthrough. So they did their big breakthrough in years 12 to 13 as they were shifting to the enterprise model. And so I think those would be 2 examples of companies that I would look at retroactively on how their story was a success. Those are pretty good case studies. There's a bunch more in the book as well.
So how do we balance, is another question, how do we balance remote workforces and meetings with VCs need to personally get to know their companies, dinner meetings and et cetera? How can they be compensated for, and how can investors get comfortable with remote investing?
Yeah. So, I I'm a little bit biased. I've been doing Zoom heavy investing for a long time because many of the companies I've backed have been international, across the US, outside the Valley. So I'm definitely biased on that. You know, one data point that is really interesting is the average venture relationship in America is longer than the average American marriage. And as a result, it's really important to get to know the person you're partnering with and make sure that mindsets are aligned, values are aligned, and you both have a similar vision for what you want to do for the company. And so I think you cannot replace spending a lot of time together. There is I prefer doing that in person, but I think you can get around some of that by Zoom as well. And doing Zoom today is so much better than doing video conferencing 10, 15 years ago. And so I think it's an easier moment to do that than it ever was before.
How many companies have you invested in where you didn't meet them in person? And you were the lead investor.
Yeah, I have never done it yet, where we've done the whole way, where we've written a check. I've gotten pretty far down the investment process where, we hadn't met in person, but like introduced it to the IC, et cetera. But, that was just in the context of there was no quarantine. I think it's really interesting. I think we're going to go through some of these processes where that's going to happen. For us, I'm investing not just in a team, but also in a business model. And so there's a lot of folks across the organization that I try to meet. I think you could do that in Zoom, but I think one of the things that's also I like doing is being in the office and understanding, getting a feel for the culture of the organization. And that I haven't quite figured out how to do yet. But what I think is really powerful about Zoom and just about investing with remote is that I think it's okay if you still need to spend time in person. I think that's a really good idea. I don't believe that that the world is going to be all remote. I think that working from home will be more normal, but not the normal. I think there's going to be certain job categories that will be able to work from home. I think venture, a greater mix of my activities will be able to be done from home. But I think that it's still really important to be able to spend time with an entrepreneur and meet them in person, have them meet me and ask about me. So I think that will still be important and won't go away. But I do think it's an amazing leveler for the beginning of the process where, it doesn't actually matter if the entrepreneur is in Baltimore or Columbus or San Francisco. The first 10 meetings I can do entirely remote. It's a total equalizer. And I think I'm going to see more of that among venture, where like the beginning part of it, and then you could still jump on a plane post quarantine and spend a bunch of time when you're doing diligence and get to know each other. But I think a bunch of it can be done earlier.
So do you think VCs prefer unicorns, camels, or zebra companies to invest in?
What I love, by the way, is the menagerie of animals that are going in our lexicon. There's also thunder lizards. I've heard of rhinoceroses. I've heard of cockroaches. So there's a whole gamut. I think that VCs want to invest in great companies and great entrepreneurs that want to have a huge impact on the world. And you can do that. And so if you think of the unicorn as $1 billion, just a number, right? I think VCs want to invest in companies that can scale and be successful. I think it's tough to be wedded to say, hey, look, I want to invest in a company that's going to have like X or Y outcome, because some of that depends on stage. If you are a later stage investor, your underwriting case is that the company can get meaningfully bigger. So if you're investing at a $200-300 million valuation, like by business model, you need a business that can scale much larger. If you're an earlier stage investor, it's totally fine to have a business that can exit at a lower number and still have a business model that works as well. So I think some of it depends on where you're at how big the outcome needs to be. But I think we're going to see a shift towards a mentality of investing in startups that are not burning tons of cash, are not subsidizing user acquisition, are building the sustainability and resiliency into the business model. And I think that's going to become more status quo. So I'd say VCs are going to want to invest in great businesses. My definition of that is camels. But I think that they will still enjoy many of the network effects and many and the ambition to create really world-changing businesses as any entrepreneur that's starting a business anywhere.
Well, I mean, look, at the end of the day, you're an alternative money manager where pensions and pension funds are giving you money, and high net worth individuals are giving you money, and you have to get home runs in order to pay for all the ones that didn't pan out that you thought were going to be great as well. So the idea that everybody always prefers a unicorn because that's why people invest in startups, is they're hoping to get that big home run. I mean, I don't think Josh Koppelman ever guessed in a million years that his $500,000 investment in Uber would turn out to be worth billions of dollars. And that covers for a lot of other mistakes that they could make, some of them that you just don't know. So how would a venture, did you want to say something?
Yeah, I was just going to say, one of the things that I think we're going to see, this is a hypothesis and I don't have data on it yet, but a hypothesis is that if you think of the venture capital fund business model, we're going to see some shifts to that. And so even if you're doing kind of 2 and 20 normal venture, the early data suggests that businesses outside the valley, particularly in emerging markets, have higher resiliency, so slightly lower failure rate. And so the mistakes are in some ways less common. Perhaps it's harder to get the big home runs, but if you think of the power law curve that dominates venture returns, where a couple big wins really return the fund, I think we're seeing that shift where the tail is moving up. It's becoming a little bit fatter, but perhaps the inflection point on the left is moving a little bit more to the left, and the really, really, really big outcomes have been rarer. We'll see, but perhaps this like mix of failure and not failure will shift, and thus the portfolio construction question will shift. The other thing I've seen is that there's some experiments around different ways to invest. One that I think is interesting is the revenue share model, where the venture capital model took its inspiration from the whaling industry, actually, which is where they adapted, and no wonder it's called carried interest. It used to be literally what could be carried off the boat, and that led to this 2 and 20 venture capital model. One other industry that's high risk that has built a way to finance it is the mining industry, which is royalty streams, and we're seeing venture funds build themselves around that idea with revenue shares, which is essentially a royalty payment as a way to finance innovation. And so I think we're going to see some different models there too that will support entrepreneurs. And as we look to the entrepreneurship landscape continue to expand around the world, I think there's going to be more variety. And as a consequence, we're going to see more variety in the tools to support them. And venture capital is one where there's going to be different types of funds, I believe, to support different types of innovation with different types of business models. So that'd be the only point I would add, Mark.
Here's the next question. How would a venture capitalist feel about a service that is underpriced for the purposes of increasing accessibility and long-term user base? It is still profitable, but some may say that money is being left on the table.
Yeah. It's tough to give a black and white answer to that because some of it also depends on the business model. So there are certain business models like marketplace, for instance, which are two-sided, right? Where on the one side, you've got folks that pay, but you need to get the other people on the other side, like eBay, for instance, the classic example, right? You have buyers and sellers. To get the buyers on, you need sellers. To get the sellers on, you need buyers. And often in those models, you need to subsidize one side of the marketplace, but monetize on the other. I think then there's a question of, well, how much do you subsidize, and what is the trade-off you make? And I think there are a lot of businesses that in the early days choose to say, look, I'm not going to optimize on making the most money I can. But I think from a perspective of understanding the unit economics, I think it's important to, one, have at least at the base some unit economics that work. And so fully loaded, everything put in, does this business model work? And then you can make a trade-off and say, I understand the levers of action where, look, I can price it a little bit less. I can make the renewal cost a little bit more, whatever. You understand the levers, and you can make a choice and say, actually, by lowering price, I drive much better outcomes in terms of growth or whatever. And my return on capital, my return on investment is actually better on marketing. So you can make a trade-off on those, but I think you need to do it from a position of deeply understanding what are the levers of action and why you're making a subsidization, not just in service of growth, but actually in service of building sustainability and resiliency over the long term.
Did you ever were you ever an angel investor, or have you always been a venture capitalist?
I've always been a venture capitalist. I've invested in a couple angel, kind of friends businesses, but professionally only venture.
Got it. And what's been your most successful exit?
Some of the companies I'm most excited about in our portfolio, I had invested in the Series B of Chime Bank, which is today the #1 digital bank in the US, and the last round was about $5.5 billion at $5.5 billion valuation. And that one is also part of the reason I ended up at Cathay, because I had done that investment while I was at Omidyar Network, and Cathay had led the Series B. And invested in Neon, which is also a digital bank, that one in Brazil, which has been scaling. So I spent a lot of my time in fintech. Those are probably two of the bigger companies, but happy to talk through some more companies in the portfolio.
And so let me ask you the next question here. Another question, how does someone go about approaching a VC when they have no cash to fund the business and they've only been able to have sweat equity? They've only been able to put in sweat equity.
Yeah. What I tell a lot of my students ask me this question, like, how do I think about starting my business? A lot of students I teach in my entrepreneurship class, basically the class is year long, and at the beginning they come with a business concept, and at the end they pitch VCs. And the last day is I invite a couple of my friends, and they pitch them. And I advise them, like, what people want to see, what entrepreneurs want to see, is a mix of, one, your personal dedication to the idea. And so some of that might be sweat equity. Some of that might be they've taken a bunch of time off. Not everyone has the financial resources to be investing a ton of money to do everything. But I think there's some really scrappy ways that you can get to do a bunch of stuff for most business models for not that much money, just given the marginal cost dynamics of, getting a really, of Google Cloud and things like that. So I think you can get to a decent product idea with not that much money. And I think VCs want to be able to see that you've been able to be scrappy. But if your idea is really early, I think it starts with angel investors, right? It starts with personal network and pitching folks. And if you're trying to leverage a network beyond your own, I think there's some creative ways of doing that thoughtfully. If you're in a particular industry, finding mentors. That being said, I think it's tough to say, hey, look, I'm starting a company, I want to raise money the next day. Like, I think that's tough. I think if you're planning to raise a company one day, I think thinking creatively, and this is part of the cross-pollinators idea, is like, how do you start today building that network of folks that are around you that can support you? And so if you're really interested in the healthcare space, spend 6 months or a year really getting to meet a lot of people that are really thoughtful in the space. As you're figuring out your idea and conceiving it, invest in that. And then at the point where you have the idea, you already have this network of folks that you can approach. Say, hey, I'm launching this idea. You gave me this feedback. Thanks a lot. And that's kind of a good way to do it. I think it's tough to have the first meeting necessarily be an ask for money. I think it's easier to start building the relationship, iterate on the idea, work on it for a while. And that would be my counsel. At least that's the one I share to a lot of my students. And part of the reason we work on it for a year before they go out and raise money.
So for people who've never raised money from a venture capitalist before, from the first time that you meet them and you have a discussion with companies that you're interested in, how long does it take from the time you meet them to the time that you actually write the check? Yeah.
So the fastest I've ever done has been 3 weeks. And I don't recommend it, and I don't like doing that. Most of the companies I've invested in, I've known for over a year. And like I said, I think venture capitalists offer capital, but I think hopefully they also add a values-aligned investor, confidant, partner over the long term. And so I think it's really important both ways for entrepreneurs to really have the opportunity to get to know the investor, to get to spend a lot of time with them. I actually really like having dinner, inviting, like getting to meet their family and vice versa. And I'll invite my wife and we'll have dinner. Like, I think that's really important to know each other on a personal level. And so I think that I usually have a long gestation period where I also get to know the business plan, get to know them one stage earlier than when I'm investing, and see them tracked on their milestones, but also get them to know me and get them to meet some of my portfolio companies over some time. So it usually ends up for me from first meeting a year or two, kind of actually a really serious consideration of an investment, just because I'm meeting them at Series A, and I typically invest in Series B type thing. And I would recommend that for entrepreneurs to build a network, meet a lot of folks, and then kind of build a network of folks that you said, wow, like that was insightful, or that person had really good values, or I really like their firm, and build that relationship over time, such that when you are raising, you'll have the short list of folks that you're already close with, and that have shown a commitment of investing their time over time in you. And so that would be my recommendation to entrepreneurs.
So when you say you've known them over a year, what does that year look like? Touch points, depth of contacts, conversations on the phone, Zooming, whatever.
It depends. I meet a lot of entrepreneurs outside the Valley. So the first meeting tends to be a Zoom, and companies that I like and that are a really good fit, I try to meet once a quarter at least. One of the things that I really like when founders do is that they have a little newsletter where they talk about progress and what they're doing, and they mail it out with some regular cadence. I think quarterly is good. I like doing that and kind of going back and forth. I spend a lot of time looking at different sectors and things. And so when I find something that's helpful to a founder, I try to send them things. And so it's a little bit of a two-way street as well. Or think about BD opportunities as I'm meeting corporates or folks that might be partners with them. And so trying to have a bunch of touch points that are virtual, and at least once a quarter that's in person. And when I'm in town, do that kind of more in a in-person and coffee type thing.
Do you do much sharing of your thoughts on Instagram or tweet out that the folks here could follow you, and maybe you could email me your Instagram and your Twitter account?
Yeah, I'm unfortunately not cool enough for Instagram. I don't even have an account, but I do three things. One is I have a personal newsletter, which people can sign up for. It's at my personal website, so alexlazarow.com, ALEXLAZAROW. And then on LinkedIn, I do a lot on LinkedIn where I share. So those would be the two best places to follow some of the things that I do. And I have a column on Forbes that I write about entrepreneurship there as well.
So if you could send me that, we'll make sure it gets out to folks. So does anybody have any final questions before we let Alex go? Okay. Well, Alex, I want to thank you so much for taking the time to speak to us today. And we wish you best of luck with your new book and with your ventures. And we look forward to maybe having you come back again.
I would love that. Thank you so much for having me. If anyone's interested on the book front, it's out next Tuesday on Amazon, Out-Innovate, How Global Entrepreneurs from Delhi to Detroit are Rewriting the Rules of Silicon Valley. And I'm also going to host a little launch party, which everyone's welcome to join. And I'll send you, Mark, the details. But it's also available to be on my LinkedIn today. And we can take it from there. But really fun to chat.
Thank you. Have a great rest of your day.
You as well. Bye, everyone.
Take care.